everyone. My name is Jessica Rodriguez, and I'm with the NACVA and the Consultants Training Institute. So today, for AVW In Depth, the topic is Cost of Capital Navigator Case Study, a deep dive into the theory versus practice of using the revamped data sets. But with that, I'll turn it over to you, Carla, and you guys can start introducing yourselves.
Excellent. Thanks so much, Jessica, and thanks for having us here. So for those of you who don't know us, my name is Carla Nunes. I'm a managing director with the Office of Professional Practice, or OPP, at Kroll. I have many years of experience in actually conducting valuations for a variety of purposes: financial reporting, tax, lots of industries. And also, I lead our cost of capital group. So it's we call our group Valuation Digital Solutions, and all of the data, but also the thought leadership, the stuff that we write, and all the free data that we give in our Cost of Capital Resources Center. That's part of our team. Kevin Madden, who is, he is a director in this group, Valuation Digital Solutions Group. He oversees all the day-to-day tasks in the group and making sure that everything runs smoothly, and we update all the data that people use on a regular basis in the Navigator. And Kevin Latz, last but not least, who will be actually showing us not just the slides, but the case study today in Excel for you to follow along. He is a senior associate also in our Chicago office and doing a lot of the data updates for us. So we all work together. And so we thought it would be useful to have like a case study where we use a lot of these data sets together, and people might not even know how to take advantage of some of them. So we hope that that works and it's useful for you. So just a quick reminder, we used to be Duff and Phelps. Right now we're rebranded as Kroll, but a lot of you might know us still as Duff and Phelps. We're still the same team. Still, started under Roger Grabowski producing some of this data. We're still here. And with that, just as a reminder, our Cost of Capital Navigator now has two main modules. We simplified our offering between US and international cost of capital, but we added a lot more data to each of them. So now you have access, and we continue to add every day. And we are listening to our customers and people who are not customers, but say, would it be nice to have this sort of data set or that data set? And that's what we're doing. We're trying to just keep everything housed under these two umbrellas and have more and more information that valuation professionals can use in their day-to-day valuation projects. Disclaimer. This is our opinion, not NACVA's or Kroll's opinion. And we'll start with the case study. Kevin Madden will actually get started to set up the stage. And then we'll go, during the case study, we'll introduce each input. We'll go into the theory of why there's certain things, and then the practical aspect of selecting some of those inputs. Go ahead, Kevin.
Thanks, Carla. And thanks everyone for joining today. So I will kick it off and give everyone a brief overview of our case study. So our subject company, Consulting Services ABC, is a privately held company in the US, and they are in the research and consulting services. And so we can define that industry by GICS, by the GICS industry classification, research and consulting, or by GICS code 2020-2020. Our case study will be as of March 31st, 2023. And our first aspect of the case study is to estimate cost of equity capital for our subject company. So a little bit more about our company and our case study. So the first is the case study will be evaluating our subject company using, we'll be using USD as a currency of our projections, as well as USD as the currency of our discount rate. So everything will be denominated in USD. For our subject company, a little bit more about the characteristics of that company. Its sales are $7 million, EBITDA $1 million, debt is $1 million, and market cap we don't know, but we will go through that exercise in the case study. And so I'll pause here for a second. Again, as Jessica and Carla said, there is a file you can download in the chat, as well as was emailed from NACFA. And so if you'd like to follow along, it's a great exercise to see how we're incorporating the data and analyses today through Excel. Kevin Latz will be opening up Excel. Again, the opportunity to go into the chat, download the Excel and follow along. And so we'll be looking at 3 different data sets and tools in the Cost of Capital Navigator today. The first is our new view data path, our US cost of capital input. So this will be where we'll be selecting risk-free rates, ERPs, et cetera. The next is our industry benchmarking through, again, through our view data path on the left navigation. This is where we'll get some of our industry statistics. And then finally, we'll be using our company level betas, data set, and tool, again, where you'll be able to access this in the Navigator on the left navigation. As I said, the first aspect of our case study is to estimate cost of equity capital. Now, there are multiple methods and models to estimate cost of equity capital. Today, we'll be using 3 different models and methods. The first is our modified CAPM, where we're defining that as your textbook CAPM with size premia. So again, that equation is risk-free rate plus an ERP plus a beta plus a size premia. The size premia inside the Cost of Capital Navigator, we have 2 different data studies, the CRISP deciles size study and the risk premium report size study. Both of those size studies, you can use the size premia and apply it in this equation. In our case study, we'll be using a modified CAPM that uses the CRISP decile size study. The next model is our basic buildup. So again, that equation is our risk-free rate plus an ERP plus an industry risk premium plus the size premia. And again, both of the size studies from the Cost of Capital Navigator, you can use the size data and apply it to this equation. And then the last is what we call a build-up 1. And so this is specific to the risk premium report study, where the equation is a risk-free rate plus risk premium over the risk-free rate plus an ERP adjustment. And we'll dive into the details of this equation. What do these inputs mean and where to get them and how to calculate them along the case study. Kev, on to you.
Thanks, Kevin. So we've outlined the case study, right? We see some of the models that we want to use to estimate cost of equity. So the first step in retrieving some of these inputs is going to be retrieving the risk-free rate. So as we advance here, where you access the risk-free rates in the Cost of Capital Navigator, we can see on the left-hand side under View Data in the Cost of Capital Inputs, right? We put a little box right here around risk-free rates and equity risk premium, and we could see the table of data there, all running off of the selection of our valuation date, which is March 31st, 2023. And if we kind of get a closer look here, we can see exactly the risk-free rates that are being offered up for the United States. We have a couple different spot yields, and then we have the Kroll normalized risk-free rate. Now, one key thing you might want to point out is this link here. When should I use the spot versus normalized risk-free rate? Not all inputs for calculating cost of equity, right? There's going to be some level of, determining which do I use when is it correct to use the spot, when is it correct to use the normalized yield. So we try and provide some guidance here built into the app, but in terms of some of the theory behind them more generally, what is the normalized risk-free rate? Carla will talk a little bit about that right now.
Thanks, Kevin. So let's face it, a lot of the people on the phone here might be getting into litigation type situations that were disputes, could be tax or financial reporting, but a lot of them could be situations where people say, I don't agree with a normalized rate. And so why does Kroll have a normalized rate? And so before even getting into this context of why we have this, know that the only reason why we have it is because our recommended US equity risk premium is estimated against this normalized rate. So if you want to use a spot rate, you can always use a spot rate with our recommended equity risk premium by doing an upward adjustment at times when we were saying use a normalized rate. So we're never saying, don't use a spot rate. It's more so our equity risk premium was estimated against a more fundamental risk-free rate. And so if you want to use our recommended ERP, then you have to be careful to see which risk-free rate goes with that and adjust it accordingly. So just know that. And currently we're not, we'll go through what is currently versus the case study. The case study has a 2023 evaluation date, so not the current. So we'll go through that. So what is this spot versus normalized risk-free rate? And there's a lot of confusion about it. And this started actually by Roger Grabowski right after the global financial crisis, where we realized that when risk was at its highest, suddenly you had, this risk-free rate, like the 20-year US Treasury yield, collapsed. And at first it collapsed because of investors' flights to quality. So it was abnormally low. And we thought like it's going to go back to a normal level. But then what happened? The Federal Reserve Bank, so the central bank of the United States, the Fed, said, we're going to start doing something we call quantitative easing. And what that involved was buying massive amounts of US Treasury rates, in addition to agency and mortgage-backed securities, but especially US Treasuries. And they specifically said our objective is to drive long-term interest rates down. So you had this, non-market participant going into the market and absorbing all of this debt that the US government was issuing. And because, think about it, when you have like supply and demand, economics 101, imagine you'd have the same supply, but suddenly a lot of demand, you have prices going up. But bond yields move in the opposite direction of prices, so yields were going down. So we started looking at that and say, how can we then normalize this into a more fundamental rate when evaluating our equity risk premium? At first we thought things are going to go quickly into what, quote, was normal, and you could just do some sort of trending average, a simple averaging. And then we started realizing that the central bank was not stopping the QE process, and that was not going to work. And so we started looking at more fundamental methods. You can call it build-up methods, but essentially it went back to this thing called a Fisher equation. So this is actually a fundamental equation in economics and finance. By this academic who put out the book in the 1930s, very, very long ago, that said essentially that the nominal risk-free rate is a combination of expected real rate and an expected inflation. And if you're looking at the long-term risk-free rate, because that's our case, right, then you should be looking at long-term expectations for both of these variables. Now, McKinsey, McKinsey publishes the valuation, and they do it every day. And I actually have it at my desk. It's called, valuation. I can't get it here, but it's like I think about it as the Bible of the valuation, and they call it a synthetic risk-free rate. And they also recommend using it in these types of periods. Obviously, it was the book, the latest edition came out in 2020. So they don't reflect the last period where interest rates have come back more to a more normal level. Now, we do this analysis, and part of this essential analysis is looking what that real rate is. And we had started doing that since 2015. There was a lot of academics looking at what that estimate for the real rate was. They called it different things. They called it R star. They call it neutral rate. natural rate of interest or equilibrium rate of interest. And all those things were sort of synonymous, but it was sort of like just the academics looking at it. And we were looking at it too every month, and we still do. But it has now made it to the mass media. So people now use these terms as if they were normal to use, no pun intended. And so this is an example from the Wall Street Journal from August of 2023. And what they said in this case was just an extract that said, with inflation now falling but activity still firm, estimates of the neutral rate could take on greater importance in coming months. If neutral has gone up, that could call for higher short-term interest rates or delay interest rate cuts as inflation falls. It could also keep long-term bond yields, which determine rates on mortgages and corporate debt, higher for longer. So this is like why valuation professionals need to care about these things. So the Fed now talks about their neutral rate. They talk about it in nominal terms. So you have to be very careful if you are a person who goes to the Fed's website and looks at their estimates of what the neutral rate is going to be. It includes, or it's grossed up by their 2% inflation target. So to get to that real rate, you'd have to subtract that. But the bottom line is that a lot of people are now talking about this concept of neutral rate or natural rate of interest. And the FOMC, so the committee at the Fed that determines interest rates and monetary policy, in their April-May 2024 meeting, they also said that they saw the participants, the FOMC, thought that there was an uncertainty coming from the possibility that high interest rates may be having a smaller effect than in the past. And that longer run equilibrium interest rates, so here's another word, right? But they all mean the same. Longer run equilibrium interest rates may be higher than previously thought. So what does this mean for cost of capital? It means if the real rate that at one point people thought it was really negative and it was going to continue to be there into perpetuity, now we're saying that it could be higher. Then that has an implication for what that fundamental risk-free rate is. So this is a summary of these studies. As I said, we have been looking at this on a monthly basis on updates. And not every month has an update because academics are not like, pumping these things out all the time. But they are regularly writing on this topic, which they did not used to do. And there's even like websites from the Federal Reserve Bank of New York and others that have quarterly estimates, as an example. And what we noticed by looking at this is that indeed, after the pandemic, so starting in 2022, after the surge in inflation, that the real rate estimates have also started going up. So based on this range, now we have a minus 0.3% versus to 2.2%, but the reality is that most estimates are actually closer in the middle. This is the range. But if we were to look at that information, they're more like around 1%. That's the median. And so this has implications. This is the federal funds target rate for, this is the policy interest rate. So it's a short-term interest rate that the Fed is, using. And so since 2022, there was a 525 basis points cumulative increase. They still left their interest rate, the policy target rate, the same last week. And they have new updated estimates of both what is that long-term neutral rate and what is going to be the rate cuts this year. And back in March, so not that long ago, they thought they were going to cut rates this year by 3 times. 3 times 25 basis points. And now they said, we think we're only going to cut rates once this year. And then there'll be more rate cuts in 2025. So again, back to the higher for longer, scenario, which impacts our valuations. So that's something. They also have an estimate of the neutral rate there. again, in nominal terms, and it has come up since the last March estimate. It's approaching that. I mean, it's approaching that 1%. Not quite there yet, but it's approaching that 1%. So if you add that to the long-term inflation expectations, you can get that fundamental rate, which is what we have here. So these long-term inflation expectations that we cite all these sources, these were updated as of mid-May. We are actually going to be updating our mid-June estimates next week. But they've been stabilizing around this median of 2.3%. So they don't quite believe the Fed that they're going to get to 2%. They're a little bit like higher than that. But what's interesting about this is that they're now very close to each other. When interest rates started surging back in 2022, the estimates were all over the place. They were very different, even for the long run. And this is why we prefer to look at a lot of like reputable sources. That's something we've been doing since COVID hit, even for other indicators like real GDP. Because we find that in times of uncertainty, economists have a harder time predicting. That's normal, right? Like you're looking at a crystal ball. And so the best way when you have a model uncertainty or when you have an economic measurement uncertainty, you want to look at multiple sources of reputable, sources, I should say, to get to your estimates. So with that, if you were to put together those real rate estimates and this long-term expected inflation based on the latest data, right, you would get to a range of between like 2 and 5.3%. And that's like a really wide range. But this is just to give you a sense of what the range is, because we importantly show you like what the midpoint and the median of these estimates are. And they're like around 3.7, 3.5. And that's why we say like our concluded normalized risk-free rate is 3.5% currently. But our guidance is actually to use the higher of that normalized risk-free rate or the spot. Why? We're no longer in that environment of like that artificially low level of interest rates being capped at that level. So we are still going to look at the normalized rate every month, but currently we're actually recommending to not use the normalized risk rate when you're using our recommended ERP. So you should use the spot. And we usually tell people to look at the 20-year yield, the 20-year US Treasury yield, even though there are some people who prefer to use a 10 and some people who prefer to use a 30-year yield. So this is our current recommendation. We actually just lowered our equity risk premium recommendation last week to 5%. And that's based on a variety of factors. We have the free document, that the client alert that talks about the rationale of why we lowered our equity risk premium to 5% for everyone to read. But obviously, this is the current valuation, and I know that we're looking at a case study. So I'm going to ask Kevin Latz now to tell us, like, based on what we were doing at March 31st, 2023, what was our recommendation?
Cool. Thank you, Carla. Yep. So as of this date here, we can see we're selecting 3.81% as our risk-free rate here. So if we advance,
and again, that was the higher, like that was higher than the normalized of 3.5.
Yeah. So if we're looking there, we can see 3.5, 3.8, and if you hover over that, when should I use the spot versus normalized risk-free rate, you'll see that guidance there that kind of explains that, and it'll take you to some supporting information for this. So always keep in mind when you're selecting these things, check the cost of capital center, check what our current recommendation is to make sure that you're using the right input. And if we advance here, we can see the risk-free rates over time is also available. So this just kind of a nice graph here. If I continue, shows you the spot 10, 20, 30, as well as the normalized over time. And this is as of your valuation date. You can see right on the x-axis there. It's a little bit in the past, but still a useful tool to see how those things have evolved over time. So if we continue, right? We just talked about our risk-free rate. We selected 3.81, which was the spot 20-year. Now we'll need to talk about accessing our equity risk premium data. So where would we do that? It's actually going to be pretty much in the same spot as the risk-free rates. So if we look at the left in cost of capital inputs, you'll click into there. And then after selecting our valuation date, right, which is still at March 31st, 2023, we'll be on the risk-free rates and equity risk premium tab. And the equity risk premium data is just below the risk-free rates. So if you don't see it right away, just scroll down. And then this table of data will be here. And then if we zoom in a little bit, just so we can see what that looks like, we can see the 3 equity risk premiums that are available. We have the Kroll recommended. Again, look, that's as of the date, March 31st, 2023. And then we have the supply side long-term, and then the historical long-term as well. So I think we're going to go over to Carla, and then Carla will talk a little bit about the ERP, when to use which one, kind of the pros and cons of those.
I'm on mute. All right. Thanks, Kevin. So the reality is that none of these methods are perfect to estimate equity risk premium, because we are trying to estimate what equity risk premium would be in the future, right? We're looking at a crystal ball and trying to guess what the equity risk premium that investors are going to demand in the future they're going to realize. And so history is a very useful tool, but it's not the only tool. And there's some issues with historical data, which we will talk about. The point is, we're trying to give you tools for when you have to support your decision and your selection, and say that you end up going to court to try to support your decision. You have all of the tools you need to say, why did I pick this number, or a range of numbers? And so with that, let's walk through, like, how can you estimate the equity risk premium? There are 2 general ways to do that. One is the historical approach, which we just talked about, like getting what actually happened, over time. And the other one is called the forward-looking approach. And that there are different variations on how to get there, and there are limitations with them. So you have a bottom-up or a top-down approach. I'll talk about what those are, and surveys. So let's go through each one of those. So if we first look at historical data on the equity risk premium, and by the way, in that view data path that we now have, you can always click on this view supplementary ERP data, and you can see it. And so what that tells you is, listen, there is the traditional number that people are used to seeing, the 1926 through the present, but we also show a lot of other periods to demonstrate that equity risk premium is not fixed, right? It changes over time. And, there's nothing really truly magical about that 1926. We talk to Professor Roger Ibbotson all the time, emeritus at Yale, and he was the one who first created the Ibbotson Associates yearbook and all of that. And he said, well, that was when I went to the, Chicago Business School library, and I went hand collect all of those prices from equities. And that's as far as they had the data, so that was like, why 1926? Now, there are other periods there. Now, actually, there's data that goes farther than that. But, you have to also weigh in with the quality of the data. But the point is, if you look at any other period, you could have a very different indication. And in fact, starting in 1926 is one of the highest. It's like up there in the 7%. When I started doing valuation and I was using this data, and way back when, I'm not going to tie myself, but we were using 8 and some, right? And that has been coming down over time. So that's one thing that you can look at. And we know actually of some providers who will look at different periods. So some periods start like in 57 or 58, so they look at these period dates and look at what that number looks like. So the 7.17, for example, this was for our valuation date, because we pick a valuation date of March 31st. of 2023, you would have access to the 26 to 22 data, right? Obviously, if you pick a different valuation date, you'll get a different period, but it will always give you like these different decades that you can take a look at for the arithmetic average. You can also look at geometric average. Now, if you talk to Professor Aswath Damodaran, he prefers when he doesn't like to use historical data. Let's make it very clear. He likes to use forward-looking data, but when he looks at historical data, he looks at geometric. Now, there are also a lot of arguments for, I mean, it's not a settled science, that arguments between academics that agree or disagree with the use of geometric average. And so Roger Grabowski actually tries to summarize that in his Cost of Capital 5th edition with Shannon Pratt, where he goes through the arguments of using one versus the other. And it seems that for valuation purposes, like for what we do, that the arithmetic average would be more appropriate. It's the most unbiased estimate of what the future would hold. And geometric average would be better for if you're looking at your return on your 401k versus other asset classes and what they have done in the past. But it's something that you could get into a discussion. Hopefully not, because I don't think judges will want to go into that, but it could be. And so we're telling you, like, you have both. You can look at both. What happens with a geometric average is that it will always be lower than the arithmetic average because of this. You have this standard error, which we also tell you what it is. It's all here for you to consult. So the other thing you could do, because those are like set decades, but you could want your own period that you want to look at history. And so you can actually export all of these historical ERPs over time into an Excel spreadsheet. Like, you just click on it, and then you'll see every single start date and ending date. So this is an example of the US long horizon equity risk premium geometric mean, right? And you see, like, all the way from 1926 to 2022 was 5.1%. Guess what? If I go to the earlier slide, let me see this, two earlier slides, this one, there's the 5.1%. It's rounded, but it says 506, but it's 5.1%, right? So all of that data is available to you. It's transparent, traceable, so that if you're in a situation that you end up in court, you're able to trace all of this. And this same exact data exists in arithmetic average. This is just to show you what it looks like. And then finally, for those of you who use lost profits, like if you're like in those kinds of businesses, we now have historical equity risk premium with against different bond maturities, because the typical historical equity risk premium that people look at is against the 20-year yield. So it's a long-term equity risk premium. But guess what? If you have a dispute over the next 5 years, that historical ERP is not the same. In fact, I know Roger Grabowski has been presenting in a lot of NACVA, super conferences on equity risk premium and discount rates for lost profits. And he alludes to this, like, you shouldn't be using the same. Well, guess what? We now have that data. So as an example, the arithmetic average, and that's first, I know it's small, but if you have your deck downloaded, you'll be able to see it. That if you use a 20-year maturity bond, it's a 7.17%. That's what we just talked about. But if you use a 30-day bill, it's 861. If you use a 5-year bond, it's 7.51. So the point is, the equity risk premium is not independent of your risk-free rate assumption. By definition, it is the premium over and above what you would earn in a risk-free instrument. And so this will tell you that if you are using a shorter period of time and therefore you use a shorter maturity for your risk-free rate, you should make some sort of adjustment to your equity risk premium accordingly. So this is new data that is now available that did not exist until very recently. And so here's the maturities we have, and that's for the historical data. For forward-looking data, what do we have? So let's talk about what are these bottom-ups and top-downs and surveys. And so we can start with the implied equity risk premium. Both the bottom-up and the top-down are different iterations of a dividend discount model. And so they called implied equity risk premium models. That's what Professor DeModern has on his website, but there's other providers out there. And so essentially you need to know what the consensus earnings estimates are for the index you're looking at. For the United States, it tends to be the S&P 500. For other markets, it would be a different index. So if you have consensus earnings, like estimates for future earnings, and then you have data on what the typical dividend yield is, and the dividend payout ratio, you can do a DCF on the index instead of doing a DCF, a discounted cash flow approach that is a dividend discount model on an individual stock. You do it on the index. And then there's one more thing you need to know, which is what is the long-term nominal earnings growth rate, so that terminal year growth rate for earnings. And so it's earnings, not revenue. And then what is the what is the current index level you solve for? You do an implied an IRR, internal rate of return. You solve for that current rate to get to the cost of equity, and you deduct the risk-free rate. That's how you get to an implied ERP in simple terms. Here's another example of, like, not Professor DeModern, but this German website, marketriskpremium.com, which is actually quite used in the Germanic countries, and it's as the base for equity risk premium there. But sometimes one size does not fit for all. And when you're very mechanical about doing these things, you might ignore things that may give you an estimate that is too low. So for the United States, at the bottom of this page, you're seeing 2.61%. They do not take into account buybacks. Buybacks are not a big deal in Europe, but dividend buybacks in the US are a huge deal. And in fact, the buyback yield is greater than the dividend yield. And so if you ignore that, you ignore a form of return to shareholders. And so you might have an indication of an equity risk premium that doesn't make that much sense. So these are the kinds of things that one needs to understand if we're going to use those models. Don't just take it for granted that, oh, because someone published, it's okay for me to use. No, you need to know how to challenge those numbers or whether they make sense. And finally, let's look at some academic estimates of what those numbers might be. And this was a CFA Institute Research Foundation a monograph or publication. They've been doing this every 10 years for the last 30 years. And they asked a number of academics who are well known in the area of equity risk premium to see what their views are for the long run. Now, notice that they did not ask Professor DeModern to join this. He has not been part of this academic, debate. But the person on top of that is Roger Ibbotson, the guy who created all of that historical data. And he, in his view, even though since 1926 to the present, it's, the numbers you see, like they're around 7%. He thinks over the long run, going forward, his best estimate for equity risk premium is 5%. So what do we do at Kroll, formerly Duff and Phelps? Well, we look at all this data, right? Like historical and forward-looking. We see what's a reasonable range. If you think about various business cycles, meaning you need to go through estimates both for expansions on the economy and recessions. What could ERP be in those types of cycles? And then where in the range are we based on current indications? Now, this is not about our, going through various detailed estimates of the Kroll recommended ERP, but we'll just a high level, we look at, those sources give us a range of between 3.5% and 6%. We think that's a reasonable range if interest rates are at normal levels. And where are we in the range? And right now, that's what I said. We just lowered it to 5% as of June 2024. We don't have the time to go through more details of our methods, but just letting you know that if we continue to use just historical data, which is what we used to do, honestly, until the global financial crisis of 08-09, like until then, and I was doing valuations myself, and that we just used the Ibbotson book. But that would have given you a very odd answer. And the same thing happened during COVID, which is the historical ERP actually went down because the returns dropped by so much in 2008, like by almost 40%, that the S&P 500 dropped. That had an impact on the overall long-term average, even though it was only 1 year. So the equity risk premium went down, and the risk-free rate also went down because of flights to quality. So you would have been in a situation where when risk was at its highest, the historical numbers would tell you that your base cost of equity went from 11.6 to 9.5. So that's counter. Doing things mechanically, it's a problem. That's counter what you'd expect and defies economic reality. And that happened also during COVID. We're now at levels that are actually the same levels of cost of equity as they were in the eve of the global financial crisis, just because interest rates have gone up, not because equity risk premium has gone up. And so this is just shows you that our recommended equity risk premium does go up during those times, because we are trying to take all of these different, like the surveys, etc., to get to our recommendation. And we look at a number of financial market and economic indicators to see where in that spectrum we are. We're not going to show you those, but they are in the client alert. Now, if you were to use the Modron's preferred method, which she calls a trailing 12 months cash flow yield, and against a spot 10-year yield for the treasuries, because that's his risk-free rate proxy, you would get to a level where during COVID, when the risk was at its highest, his number, the COE, which is the blue line on the screen, was at record lows. So when risk was at its highest, his method would say that risk is at its lowest. And the reason is because he was using the 10-year yield treasuries as the long-term growth rate. And I don't know if you remember, but the long-term, the 10-year yield dropped to a record low of 0.5% during that time. And so that really would distort the numbers. So you have to be careful about using his numbers without, some sort of adjustment or at least some like sanity check. And same thing happened. He realized that it didn't work. And so he said, okay, I'm going to come up with a COVID-19 adjusted ERP. But sure enough, back in August, he went back to a record low. So his number was giving you a base cost of equity. So risk-free rate plus equity risk premium, he thought it was less than 5.5%, was 5.34% in August. Now, in August, we didn't even have vaccines in 2020. Like, we didn't even know vaccines would come out. So risk was not that great in terms of like perspectives of when to value a company during those days. But that's what his model would have implied. So you have to be careful when you use these numbers and be able to substantiate them before using just because it says Professor DeModron. So our recommended equity risk premium and the risk-free rates that go with it are always available for free in our website. There's a table that you can download, the PDF. We're actually going to also create an Excel version of this. A lot of people have been telling us that they would like to have an Excel version of this, and we're working on it. With that, just for this case study, Kevin, even though we personally at Kroll wouldn't necessarily start just with historical, for this example, we're going to use historical equity risk premium, right, Kevin?
Correct. Yep. So we're going to select the 7.17, just like Carla said, and I'm actually going to move over to the Excel now. So feel free to just watch my screen, or if you have it downloaded, you could also follow along. But now we're going to be looking at the Excel file where we're actually kind of starting to bring in some of these data points that we've retrieved, right? So I'm on the tab Cost of Equity Calculation. We can see some of our high level, general inputs like our valuation date. You can see the GICS code, our currency, and some of our subject company information from our assumptions. Now, what we're going to focus on are actually the data points that we've selected, right? Our cost of equity inputs. This is the goal of the case study, to estimate cost of equity. So the first thing we can see is the spot 20-year treasury yield that we selected, right? That's the 3.81%. And then we can see the historical long-term ERP we selected, which is 7.17, right? Now you can see other data is filled in. Don't worry about that yet. We'll get to it in the rest of the case study. But just focus on, right, we went into view data, we looked at the risk-free rate and the ERP we wanted, and we've brought them in. Now, these are actually hooked up via an Excel export. So if you export the view data that we've been looking at, if you look at the tabs here on the bottom, each tab will be organized by the data point. So I'm on the risk-free rate tab. We're looking at all the available risk-free rates as of our valuation date, right? And we can see the 3.81%. So it's directly linked up to the export and being pulled in for our calculations. Same thing with the ERP, right? We can see the different ERPs, and we're linking up dynamically to this selection. So in the cost of equity calculation, starting to already retrieve our inputs to then eventually start to calculate our cost of equity. So I'm going to go back to the PowerPoint here now and hand it over to Kevin to talk about betas.
Thanks, Kev. We had our three primary methods that we were reviewing in our case study today. So again, it was the modified CAPM, the basic build-up, and the build-up one. And again, all three of those had a risk-free rate and ERP. And now we're moving on to the beta input. So beta is an input in our modified CAPM. It's also going to be as part of the process to calculate an industry risk premium that Kevin Latz will do it in our next section. But for now, we'll focus in on a beta and how we access that in the cost of capital navigator. So the first is we'll be utilizing the view data path and selecting the betas and industry risk premium tab, and we can see that there's a data table that shows different beta types in columns, and then we organize by various industries in the rows. So what are all these numbers and betas? What are we looking at here? And before we get that, I want to remind everyone that we defined our industry as research and consulting, and today we're utilizing GICS to define and classify industries inside of our product. Historically, we were using SICs, and in September 2020, we did make the change to move to GICS. So I want to remind everyone that post September 2020, we are utilizing GICS as our industry classification. You can learn and read more about why we made this change. If you go into the resources library and under miscellaneous, you can select industry classification change from SIC to GICS. There's various reasons why we made the change. One of the big reasons is SICs were in the late 80s, they stopped updating that. And so, and then in the early 90s, the US government stopped utilizing SSCs in their analyses. So from updates to, market acceptance, those were some of the primary reasons. But again, there's more details into that in that document. There's also an Excel spreadsheet that we show by companies what their SICs and what their GICS were. So, if you're using, if you've had SICs codes in the past and the constituents, you could look them up here and to see, if there is a mapping into an appropriate GICS. Now, there's no one-to-one mapping from SICs to GICS. I do want to call out that we've had this spreadsheet out for a couple of years. We've had a lot of feedback from customers. One, it's outdated, and two, it just needs to be improved. So we have heard you. We are working on an improvement to this and an expansion of this this data here. So we're hoping to improve the ability for our users that we're used to using SICs and giving them a better tool to, map to appropriate GICS industry classification. So that is forthcoming. So back to the data table here. Again, we're looking at a lot of different numbers, a lot of different beta types. So I want to call out, we're looking at a bunch of different beta types, and
Kevin, just a little pause on the GICS, because I think some people still don't know, the GICS. It's a great question. Like it means Global Industry Classification System. So that's actually the system that global financial markets now use for their industry classification. The SIC code that the US government has not been updated since 1987. And so they do not have information for the new technologies, the new world, the new business. They haven't kept up because it hasn't been updated anymore. And so that was part of the reason why we decided to go through to change to GICS, to Global Industry Classification System, because that's
right.
like the mostly widely used for all our data sources. And it's very hard to match when SIC codes don't exist anymore, and our data sources, the raw data sources, just have GICS. Sorry, go ahead, Kevin.
Yep. No, thanks, Carla. Yep. So in our top row, we're looking at different beta types. You can always learn more about what are these beta types in the resources library. In the view data path, there is a resource modal where you can click in and learn more. But these are all betas that are calculated using 5-year monthly returns. In other words, 60 monthly observations. And so on the right side is what we're calling our pure play company betas. And so these are sourced from our US industry analysis. These are the median beta calcs from that industry analysis. And so when we say pure play, when we run that analysis, all the companies that make up an industry, they have at least 75% of their sales in that industry. Okay. And so then on the left side is our full information beta. These are non-pure play companies. And so it's another beta methodology where if a company has at least $1 of sales in that industry, they would be included in that beta regression. If you were an old Morningstar Ibbotson or Valuation Handbook purchaser, this would have been a full information betas would have been provided in a data table back then and used as a basis to calculate the industry risk premia table. So just another beta methodology, but to be clear, it's not pure play companies that make up that industry. We can get those pure play companies in the view data path, but if you're looking for other beta types or other ways that we've slice and dice that data, you can also go into the industry benchmarking tear sheet. So we provide the same betas, but we also calculate those betas different ways. And so again, we were providing you in the previous screen just the median betas. Here we provide those same beta types, just calculated in different ways. So we provide a composite, large and small composite, and high financial risk buckets. So again, a median, if we look at all the companies that make up an industry, it's just the median company's beta. If we look at the composite, it would be your market weighted average for all those companies in the industry. Large meaning the largest companies that make up that industry, small being the small companies that make up that industry. And then if applicable, if there is enough companies that meet our screening criteria that fall into what we call high financial risk, we would calculate statistics in that bucket. So how do we know what are these companies, especially how do we know if they're large or small? So we always recommend you look at the companies that make up an industry. So you can do that in the view data path. You could also look at companies in this tear sheet view. You can toggle between what's in a composite, what's in the large and small, and why is this important? So the list of companies that make up an industry, you want them to be comparable to your subject company. So you might find that there's too many companies that don't meet your criteria. So what do you do next? An alternative would be to calculate your own industry, and so that's why we provide the company level beta tool as an alternative. So this data setting tool is provided to really select your own peer group companies to build your own industry beta here. So this would be the third path to selecting betas inside the Navigator. So the tool here is really driven by selecting a date, the currency of your discount rate, where your company lies, the return frequency. So we offer monthly and weekly returns, a look back period, 1 year up to 5 years, and then your market index. What market index are you regressing your betas against? And so next is selecting your own peer group. So we have a company lookup tool to do that. So we have the ability to search for companies by their name, by their industry, keyword search using their business descriptions, and then some other ways to screen for companies using financial statement metrics such as sales or market cap, EBITDA, where they're incorporated, et cetera. So again, from a case study standpoint, we knew our subject company was consulting, we knew the sales, and we knew we were operating in the United States. So that was a straightforward way to filter down the results and select a few companies to build up our own industry. So in summary, again, we and especially in our case study, we're relying on a few different betas. For our modified CAPM, we are utilizing the raw median OLS beta from our industry analysis. For our basic buildup equation, we are utilizing the sum beta, and we'll explain more why we're using the sum beta when we get to the size premia.
And just one thing, Kevin, because I think there's been a couple of questions on, what are these types of betas? And it's very high level. If you want to know more detail, we actually have a free webinar on the Kroll website about best practices on selecting betas. So today's case study was about integrating all of the data, so we won't be able to go through all the detail, but just very high level. Raw or OLS is the traditional historical beta. So it's a regression based, it's the ordinary least squares, or OLS stands for that regression beta. So it's just a traditional historical beta. But there are adjustments, that try to mitigate the noise, statistical noise that exists in that historical beta. So one of them is Bloom adjusted. Now, I personally do not love using Bloom adjustment. It was actually rejected in one of Delaware Chancery Court decisions because it's a very mechanical approach of getting to a beta of 1 where beta of 1 is the market. And it's a 1/3 for the market beta of 1 and 2/3 for the historical beta. There are better methods than that. The fuzzy check method is actually better. We explain why those methods are better in that webinar, but just know that, but we provide it because some people use it, but we do caution you of when using certain types of betas in that webinar, and I'll put it again on the Q&A and chat function where that webinar is to get a little bit more details on types of betas. So this particular option is using off the shelf. Option 1 is use an off the shelf beta, and in this case you could use some beta, which, as Kevin said, is like to be commensurate with the size study that we will use. So go ahead.
And like I said, option 2 is to create your own industry beta, selecting your own comps using the company level beta data set and tool. And we've run through levered and unlevering those company level betas and relevering it. And here we could be selecting a median relevered beta as an option. And then finally, back to the beginning where we talked about the differences between the pure play and non-pure play, the non-pure play company level betas, and that would be your full information beta in that data table. And then one final remark here is when we're selecting our industry betas, these off-the-shelf betas based off the companies we've selected. There is a capital structure tied to these betas, and when you utilize this, you must select if your capital structure is different than the capital structure of the industry is different than your subject company. We would recommend you would select a unlevered beta and relever at the appropriate capital structure of your subject company. So on the tear sheet view, you would be able to see what is the capital structure of this industry for these betas.
I'm going to talk a little bit about the industry risk premium. Now, this is something we get questions about often. Where do I find industry risk premium? What is an industry risk premium? So really simply, it's just an up or down adjustment using the beta and the ERP as inputs. So if we're looking at kind of a simple buildup, which is what we see above, right? We have our risk-free rate plus our ERP plus the industry risk premium plus the size premium. And then below, we can see just how that RPI or the industry risk premium is calculated. It's the beta times the ERP minus the ERP. So if we want to calculate an industry risk premium, we're going to need two inputs, the beta and the ERP. And you should be consistent with your ERP selection in the industry risk premium in the sense that the ERP you use in your cost of equity should match the ERP underlying your industry risk premium, right, to be theoretically correct. So if we advance a step here, right, we can see the same formula up above to calculate our industry risk premium, and we're going to calculate it three different ways using those same options that Kevin just showed us. So the first is the 0.87, which was from the industry benchmarking data set. We can see that final calculation minus 0.93. We also do it for the custom beta, right, using the same ERP. Again, we can see that adjustment. And then also using the full information beta. Now, you can also follow along on the Calc Industry Risk Premium tab. So I'm going to go to that now. I'm back in Excel. I'm going to go to the tab Calc Industry Risk Premium. And now we can see kind of those same calculations being done, matching what we see in Excel, right? Here we can see the beta using the sum beta. Here we can see it with the custom beta using comparable companies. And then again with the full information beta. So, this is a useful tab to have on you if you forget where do I find an industry risk premium, how is it calculated? This is right here. And then you could always use this to plug in your own numbers and get that industry risk premium. So go back to, go ahead, Carla.
And so the bottom line is, like, people think about industry risk premium as something like, esoteric, and they don't really know, like, oh, there's just some calculation. Well, anyone can calculate their own industry risk premium. It really is based on a beta. It's just an adjustment to have this beta become a build-up method. So we're adding something instead of multiplying. So that's just a mechanism by which to do that. So the key there is, what is your source for beta to come up with that industry risk premium? So the traditional Ibbotson, books, the Ibbotson Associates yearbook, and then Morningstar, they just would have this full information beta for the calculation, meaning that you could just have $1 of sales in that industry and you are captured. That's not a pure play. And so it has more companies. So people think of that. It's like, well, I don't have a perfect number of companies. So that way, any single company that has sales in this industry will be captured. That's what people were used to doing. But again, it was also a function of when data was not available. And now you have a lot more data available at your fingertips, and you can hone in on those selections of like what companies are pure plays. And so from a cost of capital theoretical standpoint, you want to be using pure plays unless you have absolutely no choice. So the full information beta for me is the last resort. It's like when I have nothing else and I cannot find companies that are good pure plays for my subject company, then I might go to the full information beta, which is any company with sales in that particular industry. But just knowing that that's like a limitation.
Thanks, Carla. And the key thing Carla said is anyone can calculate this, right? I just kind of did this off the shelf after I pulled data. But if you want to just access the industry risk premium without having to calculate it yourself, we do provide that here on the betas and industry risk premium tab we were looking at before. So right underneath the betas, we'll calculate the industry risk premium for you. The key thing is you see up above the historical long-term in that dropdown. Since the ERP is an input, will allow you to change the ERP, so that it'll change the calculation of the industry risk premium. And we can see here off the shelf, as long as we're using that same ERP, we can see that our output is matching here, right? So for the full information beta, we have minus 0.86, and we can see that's coming right off the shelf. Same with the sum beta, minus 0.93, and you can see it's the same right here. So, as long as you know the ERP that you're using, it'll make sure that you have the correct calculation for your industry risk premium. Now I'll advance to Carla, who will talk about size premium.
And of course, this is a very high level, size premium, and a lot of you will know this by heart. So this is just a summary so that we can go into how to use the data together. So, two of the major traditional size studies that existed was the CRISP decile size premium study, and that was really what Morningstar and Ibbotson used to publish, right? So we took over that work from Morningstar with their permission, and we still talk to Professor Roger Ibbotson on a regular basis about these topics. And the other one is the Kroll risk premium report size study, which really was something that Roger Grabowski had started when he was still at PW, so Pricewaterhouse, with back then a research director called David King, and they started that study at Pricewaterhouse, and then they continued it in PricewaterhouseCoopers, and then Standard & Poor's, and became the Duff and Phelps risk premium report study. Now it's Kroll, but like this has a long time ago. Now our experience is that the CRISP decile size study, the Ibbotson former study, like has a wider use, but that is based just on market value of equity as a measure of size. And sometimes there's difficulties in using that just market value of equity, particularly for private equity. I'm sorry, for private companies. We'll show you a way of getting around that in our case study. But there is advantage of looking at other size measures, and some of them are better than others, but a lot of times you want to look at things like sales and total assets. Like those are two examples I think that really and that have better statistical significance of like what would be a measure of size if you don't have a market cap, which here it's labeled as market value of common equity. So it's always a good idea to look at more than one dimension. So I think that using both studies is actually very, very useful. Not just I wouldn't ignore the CRISP decile size study because a lot of the academics will suggest that having returns weighted by market cap is the way to go, whereas the risk premium report is based on equal weighted returns. But having said that, there's value to both studies. And so the question there is, sometimes the market cap can be, for example, could be understated because the company is in distress. That's an example of where things might not work. And the other thing is, like, you have to guess, where are you, right? There's a circularity issue there. So at the end, you want to make sure that when you arrive at a conclusion for the value of equity, that it still fits at the bucket that you picked. for it. So if you can, it's a good idea to look at multiple directions. And I think that now we'll go through an example of how you can not get rid of, but help you with that circularity issue. And then from there, we can say, like, there's value to both studies, that you want to make sure that you look at things from different directions. Go ahead, Kevin.
Yep. So what we're going to do is access the size premium, right? We've already done this with the risk-free rates, the ERP, the beta. So the last piece we need is going to be the size premium. It's accessed right through the same spot, right? Cost of capital inputs. So if we zoom in a little bit, right, just so we can kind of see what the data looks like, there's going to be the low-end breakpoint, the high-end breakpoint, and then the size premium. So the key thing is we're trying to find within what breakpoint do we fall into in terms of size. This is by market value of common equity. And then we apply the size premium based on where we fall. So one way of determining our market cap, right, if we don't know our market cap, would be to use some of our enterprise valuation multiples, which these are available in the industry benchmarking data set. Right, this is where we got some of our betas from earlier, if this looks familiar. So we have EV to sales multiples, we have EV to EBITDA multiples. And if you remember, we had some company level assumptions at the beginning of our case study. So I'm going to go over now to the Excel, use multiples to estimate size. And this is what it's going to look like here for those who don't have the Excel open. But if I move to Excel here, I'll go to the tab, use multiples to estimate size. And we can see again our assumptions, right? Based on the multiples we'll be using, EV to sales and EV to EBITDA. We hooked these up to our assumptions. What we're doing we're bringing in these multiples from the actual tear sheet. So what we saw in the PowerPoint here, I actually exported this all this data into Excel. So if I go over here, right, we can see US, USD, then our GICS code, we can see actually right where these multiples are coming from, along with all this other great data, right? So if I go back to the tab, use multiples to estimate size, we have our inputs, we have the multiples, and then we're just kind of doing the simple analysis here, multiplying. We're going to weight each of these, just to add a little bit more robustness to our analysis. We have our concluded estimated enterprise value. We can subtract the debt that we have, again, from our assumptions. And then we end up with our estimated proxy for market cap. So, right, this is just one method using some of the multiples. We do have other multiples available as well to estimate our size. So once we have our size, then here we can actually then select, based on the bucketing. So we're about 12 million. So we're going to fall between the 2 and the 218 million, and then apply this size premium from the smallest bucket, right? So this is the first study, the CRISP decile size study. We're going to look at an alternate size study as well, the risk premium report size study, and then we can see the premium that would need to be applied there. So now we'll advance to the risk premium over the risk-free rate, which Kevin Madden will talk about.
We've concluded on selecting a size premium where we have a basic understanding of what a size premium is. Now we can go into this other input that's used in our build-up one equation, and that's this risk premium over the risk-free rate. So the most simple way to think about this analysis and input is the risk premium over the risk rate is a combination of your market and size risk. So your ERP and your size premium embedded into one. So in the risk premium report size study, there's another analysis that calculates this and produces this type of data where it's the combined impact of your market and size risk. So with that, there's another input, this ERP adjustment, and what is that, and how do we calculate that? So The ERP adjustment is necessary when you're using the risk premium over the risk-free rate because it takes into consideration and accounts for the difference of the ERP that you selected in your analysis and that ERP that's embedded in the risk premium report size study analysis. So, for example, in our case study, using the risk premium report over the risk-free rate study through 2022, the ERP that's embedded to calculate that study is the 1963 to 2022 arithmetic average historical ERP. So that's the ERP that's embedded as our market risk in that input. So we're using a different historical long-term ERP, so we need to account for that difference. And so it's really just the delta of that. It's our 7.17% less the historical ERP that's used in the risk premium reports study, the 5.59%. Gives us a around a 1.6% ERP adjustment. So that completes that build up one equation. So where do we get the 1963 to present ERP? That's in our view supplementary ERP data in our cost of capital inputs. What Carla had showed previously, it's the table that shows all the different historical long-term ERPs calculated with different start dates. No matter what your valuation date, there's always going to be an option that shows the period date of 1963 to present. So you can always calculate that ERP adjustment if you choose to use the risk premium over the risk-free rate, or using that build up one method. So now that we've calculated our ERP adjustment, we'll go back and again, following the same format that Kevin's been highlighting here in this presentation, you can get that premia going through the cost of capital inputs, selecting your date, and then running down to the risk premium over the risk-free rate tab. We know our size that Kevin just went through, our 12 million, and this is just again one input that we could be using along with all the other size measures that Carla highlighted. But for simplicity, we'll just we'll select our 13.38 based off our market cap and use that in our study for our build up one.
This is some of the supplementary CRISP decile size study. There was actually a question on the Q&A about, whether if you're using the CRISP decile size study, whether you just stick to decile 10 and or can you go to the underlying detail. And if you click on that supplementary data, you'll be able to see more detail about 10Y, 10Z. Actually, we now have, even W, X, Y, and Z, and to see the details. And there's more information we're going to make available, which is instead of having what this is showing you is the characteristics of the companies in each of these metrics. So each of these metrics, for example, total assets right there in the middle, what is the largest, the 95 percentile for the companies that are in 10Y is a billion two in total assets. And the fifth percentile is 17.5 or 0.6 million. So this is sorting each individual risk characteristics, so size metric, and look at what are the largest and the smallest. What we're going to do next is we're going to show you if you just kept market cap, so market value of equity, as the sorting mechanism, what would be the characteristics of those companies? And we've done that analysis offline. And what we find is that there's two things to think about these companies. These are like the bottom, like the 10B, right? Companies. What we find is two things. One is that the debt levels, so total debt to total capitalization, that a lot of these companies are actually they don't have a lot of debt. So some of them do. So there's a lot of people say you cannot use 10Y and 10Z because they're distressed companies, and therefore, they're not a good proxy for other types of companies. And by distressed, they mean like they have a lot of debt. What we find is that not all of these companies have a lot of debt. By looking at those ratios that we will be sharing in the Navigator in the near future. The second thing we find is that a lot of these companies are actually probably startups. And how do we measure that? We can see that by the ratio of market cap to book value of equity. It's called the market to book. And so for companies that have a lot of growth in them, they might not have a lot of assets. And their earnings might be still negative. So their book value of equity is small, but the market value is large. If you have a high market to book, usually that means that you're looking at high growth companies. And a lot of times that those are actually startups. So what I would say is that if you're using this sort of thing, this sort of like data, that you're looking to substantiate the cost of equity for a startup, this might actually be a good, supplementary data source for your analysis, because some people are using surveys like the Pepperdine survey, right? That's based on a survey and what people are telling you. Another method is to look at what's the actual, what is happening. And so soon enough, we'll have that data that will show you those market to book analyses and the debt to total capitalization. And you'll see that not all of these companies are made up of distressed companies. Some of them are just made up. They'll actually have positive EBITDA. And so you'll see that those companies are, that maybe what you're looking at is a good proxy for those types of companies, for those of you who work in that space. Now, if you're just looking at a small company and they're just regular, run-of-the-mill mature company, I would not go into this level of detail. I would not start using 10Y and 10Z just to make cost of equity look higher. You really want to know the characteristics of those companies and match it to your company to see if you match those same characteristics. If you're a company that is losing money, then maybe you look at this, right? But you have to be careful about matching the characteristics of your subject company to the characteristics of the data that is here. And as I said, now we have 10X, Y, W, X, Y, and Z. So this is just at the bottom, but you also have the 10A characteristics. So with that, I'm going to pass it over to Kevin Latz to go over the how do we bring it all together with all of these methods? What does this mean?
Thanks, Carla. Right. So if we think back to the beginning of the case study, our goal was to estimate a cost of equity. We've been retrieving inputs to do that. So if we look at our basic RPR buildup 2, for example, we have all 4 of these inputs now. We had our risk-free rate, we had our ERP, we got our industry risk premium and our size premium to calculate a cost of equity. Now, I'm going to go to the Excel where we can see that. I'm going to go to cost of equity calculations. We saw this earlier in the presentation. We can see all the high-level data that is available up here. Just like before, this is all linked to our Excel export. So, it is all linked up, ready to go. And then we have a couple different models here of estimating cost of equity. So the first is the CRISP CAP-M. So we're using a beta instead of an industry risk premium, and we're using the CRISP size premium. We do have a spot here for the company-specific risk premium. Theoretically, that would be added at the end. We have this all at 0 for now, but we included it in case you might want to use this as a template on your own. And we can see based on the different inputs here, using the beta and the CRISP CAP-M size premium. Here we're using the risk premium report study size premium with the build-up 1, which is using the ERP adjustment that we talked about. And then here we're doing the risk premium report study with build-up 2, which is using an industry risk premium instead of a beta. And we can see, right, the range of cost of equity that we're now establishing down here, 14.7 to about 18.8 on the high end. If we want to round that down, 15 to 19, and then we have our concluded cost of equity of 17%. But right, these are just kind of three methods that we've chosen. Just like the question Carla was responding to, when do I use decile 10? When do I use decile 10Z? You can do some sensitivity analysis to calculate cost of equity. You could calculate cost of equity in so many different ways using different ERPs, different size premiums, using different betas. So we just did a couple different ways here that you could look over as well, right? Using a different equity risk premium, using the 10Z size premium, and then using the risk premium report, but with our recommended ERP instead of a historical ERP. And again, all these data points are linked up to the exports that we have in the Excel workbook. So lots of different ways you can calculate cost of equity using the inputs that we've provided. And now if I advance here, right, we're just looking at what we saw before, kind of the summary of the three different models we looked at, and then a concluded cost of equity of 17%. So we'll move on to capital structure, and Carla will talk a bit on this.
Yeah, and before I go there, like on the scenarios that Kevin Latz was showing on the screen, I mean, you have to know your audience, right? What are you doing? So, for example, if you think your project might end up in the Delaware Chancery Court, as an example, well, they tend to accept the supply side equity risk premium, right? So know your audience. So probably you should at least include a scenario where you're using that supply side. Now, you may be using other selections, but you may want to consider the supply side as one of your selections because that's your audience. You want to be careful about the audience of the jurisdiction where you're going to be end up. Is it like the tax court? Is it just financial reporting and you're looking at auditors will accept, right? So know your audience. That's one of the first questions I ask, like who's going to be reviewing this? Because that actually, and I'm not saying that the value that you're trying to target a specific value, you are trying to arrive at an independent value conclusion. But you also want to make sure that you understand what is going to be accepted and include that as a scenario, right? So in this case, as I said, if you were going to go into the Delaware court, that's your jurisdiction, then you want to consider using a supply side. Not to say that you don't use others as scenarios, just saying like, make sure that you're able to support what you're using. And so this is just giving you different variations and the ranges are quite wide, right? Like you're talking about, 14 to 20, right? And the 20 was where we used the 10Z because maybe you have a company that is losing a lot of money. Now it's in the startup category, and that's where you are. You're in the higher end of the range. But you have to be careful when you select every single input. What's the rationale for choosing that? And again, knowing your audience. So if you go back now, Kevin, to the capital structure. Now, a lot of you may not get into a WACC. Maybe you stop at cost of equity and that's where you're at. But if you're going to go to the next step and estimate the weighted average cost of capital or WACC, then you have to be concerned about the capital structure, right? And the capital structure, just like a little bit of refresher, in theory, if we were just following corporate finance theory, like when we went to school, we are supposed to use an optimal capital structure. What is that number? That is when you maximize the value of the firm. It's that level of debt versus equity that you maximize the value of the firm. Now, the mechanical WACC templates that we have don't take into account the fact that if you start putting too much debt in the capital structure, that bankruptcy costs increase. And suddenly your cost of debt should go up, a cost of equity should go up, and that there's a good probability that you're going to be in distress and you need incremental risk premiums for distress, right? Mechanically, if you just look at and I've seen this many times over the years, people said, oh, this company has 80% of debt, but look, I'm coming up with such a low cost of capital, or like WACC. And it's like, why? Two things. One is they were assuming that the interest rate, interest expense deduction was always available when you're distressed, which is not true. They weren't adjusting the cost of debt to be higher, because when you have 80% of debt to total capital, guess what? Banks and financing providers will charge a higher rate. It's not going to be the industry average number, right? And so if you have higher cost of debt and you have like this potential distress, then that you need to incorporate. Your WACC template will not incorporate that. You have to be aware of that. So what about if I'm dealing with a private company and I'm going to like migrate to a certain level? So the cost of capital 5th edition, now this is the Bible of cost of capital. So Appendix 21A tells you how you could do and has an example on how you iterate, because you don't have market value of the equity. That's what you're trying to get at, right? So if you have a private company, and that explains you. Now, in most instances, it's not worth going through this exercise because it is very time consuming and convoluted, to apply. So you have to see like cost benefit. Is this going to change your conclusion materially? Is it worth in your budget? But it's there. So the other things that I consider is, what are you valuing, right? Are you valuing a controlling interest? Or are you valuing a non-controlling or minority interest, right? So because if you are valuing a controlling interest, you can change the capital structure to be more in line with the industry, right? And so a lot of times what people use is the industry average as a proxy for that optimal capital structure. Now, it doesn't always work, and I'll give a couple of examples when that doesn't work. But if you are valuing a minority interest, you don't have the ability to change the capital structure. So you have to deal with what you have, right? And so in that case, you may have to use the existing and potentially migrate to an industry level if that's consistent with where the company is headed. If they're always going to stay at that level, then that's what you use, right? So that's just something to consider. Now, on the capital structure, like your best practices, so things to take into account. I said that sometimes the industry average doesn't work. You know where it didn't work? During the global financial crisis and during the height of COVID. And the reason is because we tend to use the book value of debt as a proxy for market value. And in times of distress, what happens? Market cap goes down significantly for your comparable companies. And then suddenly you have this huge debt weight overall as a weight of the total capitalization. But guess what? If the market value of equity really decreased that much, chances are the fair value or the market value of the debt also went down, right? So we're not really doing apples to apples. And that also happens in interest rate rising periods, where the debt was at a certain level that was with a coupon rate that was very low, let's just say 2 or 3% or whatever it was. And then suddenly, if you went to the market today, you'd have to pay 7%. Guess what? The book value of debt, again, is not the same thing as market value. And so you can have very different weights. So one way, of course, would be to review fair value footnotes in financial statements for the comparable companies. They have to disclose what's the fair value of debt. It's mandatory, both for IFRS companies and US GAAP companies. But that does require some extra work. Why? Because Capital IQ and all these data providers that give you the data, they only provide you with book value of debt. They don't go into the footnotes of the financial statements to tell you, oh yeah, but they said that the fair value of the debt this quarter was this. Another way is to try to do maybe like a longer term average capital structure in these times of periods that things are a little bit in trouble. So for example, use a 5-year capital structure average, consistent with maybe a beta that is over 5 years. Some people I've seen using a 10-year capital structure. maybe it's harder to justify. But the point is, there's things that sometimes your capital structures are distorted, and it's time to look at it. I can tell you, when I was working with casinos during 2008, and a bunch of them ended up going bankrupt. But before they went bankrupt, it seemed like this, but 90% of debt or 80% of debt, and almost like no market cap. Like, you wouldn't be able to use that as your proxy without further adjustments. Now, the cost of capital Navigator has this industry benchmarking data, right? Where we do tell you, for the pure plays, right? For the industry off-the-shelf pure plays, what is the debt to total capital of, the latest as of that particular quarter, and the 5-year average. So in this particular industry that we were dealing with, the research and consulting, these were like the median, for example, debt to total capital was in the 15 to 17%. Was actually not that different 5 years ago, the 5-year average. But it does give you this sort of like data that you can use. Now, total debt in the Navigator includes operating leases. So operating leases are considered debt. That's also consistent with US GAAP ASC 842 that introduced that as operating lease liabilities now being as a form of debt. So you can get that information, but you can also look at what optimal capital structure is. We're going to actually make this data available in a more accessible way, but for now you can go to the resources library and look at the work that Professor John Graham at Duke University is doing. He actually wrote a paper together with his co-authors, Jules Van Binsbergen and Jay Yang, and they wrote a paper, they got published, and now we have a relationship with Professor John Graham, and he updates this information for us so we can compare. And so for this particular industry, for example, as of March 31st, 2023, the median industry level, we just picked the latest, we could have picked the 5-year average, was 15.8. The optimal capital structure was actually a little higher, was 23.6. But this gives you a sense of like, it's probably around 20%, right? So that's something you could use. And then you could look at your selected companies. Now, for simplification purposes, we only pick 3 companies. I mean, honestly, you would have to go very carefully in your case study and see which companies are really closer to you in terms of the comparable companies to pick them. But these were the ones we picked for the betas because we wanted to have a smaller number. We don't usually like to use just 3 companies, but to make the example simple. And so here we would have like, what's the median and the average, and it's a little lower for these companies than it is for the overall companies that are in those data sets. So with that, you could compute a WACC, and it's the final part of our project, our case study, and Kevin Latz is going to show us the results of, putting the WACC into the spreadsheet. Go ahead, Kevin.
Thanks, Carla. So as we advance here, we're going to see kind of just the summary, and then I'm going to go to the Excel here. If you want to just take a quick look, going to move to the Excel where we'll dig in a little bit deeper to the WACC estimate. So go to the tab, the WACC estimate. We have this hooked up to our concluded cost of equity conclusion, right, which was that 17%. You can see we're just taking the median cost of debt estimate for our industry, which again is from this whole table of industry data. So this table has the cost of debt, some capital structure, our enterprise valuation multiples, levered and unlevered betas. So, just keep thinking that this industry data set is a great place to retrieve data along with the others data from the view data path. So we have our cost of equity estimate, we have our cost of debt estimate, and then we really just need our capital structure, which again, just like Carla talked about, we're going to be pulling from that same industry tear sheet. We can see our equity to total capital 85%, debt to total capital 15%, and then our tax rate we just sourced from the tax foundation. You can get the tax rate inside the Navigator in our company betas data set, so you can find the tax rate there, and then really just doing the simple WACC, right? Taking our cost of equity, cost of debt, weighting it, And then we have our final rounded WACC of 15%. So if I go back to the PowerPoint here, right, we can see that summary. But if we want to dig into where some of that stuff is coming from, right, getting the capital structure again from industry benchmarking, you can see that here. Accessing tax rate data, there'd be two ways you can get this. The first would be through US cost of capital estimates. You can skip straight to step 3 to our built-in WACC calculator. So in these drop-down boxes, you could just manually type in, once you have your cost of equity, 17%, weight of equity, 50%, whatever it may be. And then we have the tax rate available off the shelf right here. You could also get the tax rate through the company level beta module for the US. And that is the end of the case study, right? We just showed kind of the inputs for the WACC and the final WACC selection right there.
All right. And so we still have time for a few questions. That we've been trying to answer some questions throughout. But I wanted to highlight one important thing. For those of you who are valuing really tiny companies, you might think, well, gosh, no, there's no way I would have just a cost of equity of 17%, and so what we don't include here, and we're not suggesting whether or not you include it there, is a company specific risk premium. So if you think about it, a lot of people, the way they get to a higher cost of equity is because they're using some sort of company specific risk premium. Now, again, you have to know your audience because some courts don't accept it, right? I still am in the traditional corporate finance world where I would prefer to incorporate some of those risks via cash flows, like a scenario, a probability assessment. But I understand that that's difficult at times to do. I still think that the company specific risk premium documents that the Appraisal Foundation is working on is for financial reporting purposes, but will include useful tools for people to try to quantify company specific risk premiums. When that comes out, I'm actually eagerly looking for that. I think at one point Larry Masson was here in the audience, and so shout out to her. She's working on that working group. So I think that's one of the things. So for sure, these numbers are excluding any company specific risk premium, and so it's just a pure build up of a cost of equity. So that's one thing. So with that, let me try to see a couple of the questions to see what we can answer. I'm going to go by order of that they were in the chat box. I think one was about the use of arithmetic versus geometric average for the historical equity risk premium. Honestly, I think you really want to look. The discussion is a little bit longer than I could give in this particular webinar. So I really recommend. I'm going to tell you the cost of capital 5th edition. I'm going to tell you where that's at. It's chapter. Let me just give you chapter 8A, appendix 8A, and there's a whole section talking about using the geometric average for compounding and the arithmetic average for discounting. And so I would highly recommend you look at those few pages and tells you about using an arithmetic average equity risk premium in valuation, so for discounting, whereas the compounding is the returns for, say, a portfolio. So that's the first one. And then there was another question that talked about what is the suggested tax rate to be used for the WACC calculation for a pass-through where the entity itself pays no tax, personal income tax rate. Well, so that question actually is beyond this particular case study because there's very different views of whether or not you tax effect a pass-through, right? And it seems that there's some consensus arising that you do tax effect, but what is the rate you use? But that's not a given. That's not a given. And that's a point of a significant dispute, and we're not going to resolve it in this particular presentation. So the next question is, to be clear, is the actual debt wasn't at 15%, you'd have to iterate the WACC before arriving at 15%. Yes, so if you were dealing with a private company, or just a company that doesn't have that level of the optimal 15% level of debt to total capitalization. Again, it matters what's the purpose of your valuation. Are you and whether you're valuing a controlling interest or a minority interest. Let me actually give you an example of where, it's for financial reporting, but if you're doing a 40 and also tax 409A, right, a 409A where you're valuing stock-based compensation, and they can also be used for topic ASC 718 for financial reporting. And in the financial reporting world, what it tells you is that until you have a liquidation event, while you're stuck at being a minority, you use a WACC that is commensurate or consistent with being a minority. You can't change it. And so it might be that it's not the optimal level. You have a different level of debt that you have during that period that you're stuck being a minority. But then after it, for example, if the company is owned by a private equity and you expect the private equity to exit the investment in 5 years, that's a typical liquidity period that they have, or holding period, I should say, holding period. So after those 5 years, you might want to migrate into a optimal capital structure, what the industry would be, because any company that a strategic investor, for example, comes in and buys that portfolio company from the PE holder, they would not use that over-leveraged ratio that a private equity firm might use. So you could have two different WACCs, for example, depending on that holding period and who owns it. So the point is, you may if you're a controlling interest, maybe you want to use already like the industry as a purpose. But if you're doing a minority, then you have a different perspective on what that capital structure should be. Okay, what is the fair market value of a company that has negative capital? It has equipment, but all on debt. Not sure that I quite understand this question. Maybe it's based on like book value of equity is negative. If that's it, like that doesn't mean that there isn't positive value. But I'm not sure. Like I can, without the more facts, I could fully answer this question. And then there's another question that says, in the modern class at NYU, advanced valuation, he factors what rating of debt of companies such as BB, etc., that would affect the stated debt cost. Absolutely. I mean, it's not just the modern. Like it's just you should be looking at, if I didn't have these. If I was just valuing a company standalone without having these frameworks that I need to worry about of what is the purpose, I would want to know what is the risk of the target. What is the subject company's risk? And therefore, the cost of debt should be commensurate with that. So if the company is like a BB, then you want to be considering that if they're a single B or a double B, they're not like a single A. Their cost of debt should be commensurate with what you're valuing. My caveat is that that's what he's valuing. The modern is only valuing things on like, I'm just valuing a company. I don't care about any frameworks. He hates fair value. He hates fair market value. He doesn't, it's like, he says those things that people are pricing, that's not true valuation. And so he comes at it from the true valuation world. Now, if you're valuing based on a constraint of what you're, if you're valuing because this is a marital dissolution, or if you're valuing because it's a financial reporting for where you have to take into account market participants' assumptions, that will change your WACC assumptions. It's imperative that you understand your audience and the purpose and the premise of value. And so that could change things. So Demodron will never have to deal with that because he's only valuing the pure theoretical. I'm valuing a company today. I don't care about any frameworks. I'm going to trade this in the stock market. That's not what you're doing. You're not valuing a company in the stock market. So you do have to know these other constraints, right? So that's the only thing. But I personally, I absolutely look at the current cost of debt commensurate with the debt rating that we're assuming for the WACC. That could be industry average, or it could be, like the company specific debt rating. What are your thoughts about Salvideo and Partners betas that are published? I haven't looked at them recently, but when I was looking at them maybe a couple years ago, they have a couple of things that you need to take into account. One is they use net debt instead of gross debt for the capital ratios for purposes of unlevering. So what does that mean? If you have a company that has a lot of cash, that means you deduct the cash to get to enterprise value. And sometimes they had you could have negative debt ratios. So you have to take into account when you're looking at unlevered betas, be careful with that. The other thing that I noticed is that there was a number of regions/industries that only had 2 or 3 companies in those in industry betas. And again, for example, in the Navigator, if we don't have 5 companies, we don't have an industry, because it varies too much from quarter to quarter, just because you dropped or added a company, and you have to be very careful about those distortions because of this low sample size. Even 5 companies is low, to be honest. If you're looking at industry metrics, you should be looking at something even bigger than that. But knowing there's a constraint on number of companies that are out there in a given industry, we sort of met that halfway. But if I just have 1 or 2 companies, that's not an industry. It's 2 companies. So you have to be careful about those. But I'll look again at the Salvideo and Partners, their data, to see if, what kinds of improvements they have made to it. I just want to say thank you so much.
Thanks all.
Thanks, everyone.
All right. Thank you very much.